All right, folks, let's do it. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. Today is Tuesday, the 6th of December. I'm JD Durkin. Opening bell rung just moments ago here on the floor. And I do mean just moments by F&G Annuities and Life. This in recognition of their public listing. Congratulations to them. Let's take a look where the major averages stand. Stocks are actually trading green fractionally right now after yesterday's session saw a steep pullback in the major indexes with stocks notching their worst day in nearly a month. Chris, am I right? Are we in the green right now?
We are
fractionally? Yeah, we are. The S&P is currently down, trading fractionally in the red. See, that's what we do, folks. They know at this point, if I don't have the information in front of me, you pick your head up and you look at the big board. Also, Chris is here, of course. The massive sell-off came after a hotter than expected services sector report.
That's right.
Stoked fears that the Fed will need to hike rates for even longer. And of course, as we know, keep rates at that elevated level for longer. Taking a look for what is on tap for this morning. As you see, we got a special guest here in person. We will be talking market activity as investors bet on the Fed's next big move next week. We are all so excited. We're all kind of like nerds for monetary policy here, aren't we all? Plus, we break down the hotter than expected data we saw yesterday as investors anxiously await that meeting next week. And finally, we'll talk China as that country looks to ease COVID restrictions. That's certainly welcome news by many. For more on those stories and so much more, we bring in Chris Versace, co-portfolio manager of Action Alert Plus. Good morning.
Good morning, JD.
Thank you for being here. It's been a minute since you've been on the floor.
I think we got here a little early. My partner in crime, Bob Lang, is here. I think he's milling around somewhere.
Milling around.
Well, yeah, we've got the big AAP December members only call tomorrow, so we came into town to do it right here from the exchange.
To do it live, to do it right here from the exchange.
Yes,
it's
sir.
Great to have you. So let's start with yesterday's session. I don't like to spend too much of the morning show looking backwards, but I do want to give people a perspective who may have woken up today and said, I saw
What
the
happened?
NASDAQ sell, I saw a lot of profit taking. What do you think helped drive some of that action and decision making for investors yesterday?
So let's think about the context of the market, right? The people are really leaning into this December monetary policy meeting that you alluded to. The big question people are asking, and I think they're actually misfocusing, if that's even a word, is will the Fed do 50? Will they do 75? And that's next week. But the reality is we're going to go into 2023 with the Fed funds rate significantly higher than where it was entering 2022. You know, going into 2022, we were like, 0.07%, something like that on the Fed funds rate. You know, we're going to be pretty close to 5%. And the Fed has signaled that they are going to continue to keep going and keep those rates at elevated levels for the foreseeable future. So I can understand that people are always anxious. What is the Fed going to do? How big? But I think the real issue here is, where is the terminal rate? Where are they going to finish? And for how long will they keep the rates at that level?
So it sounds as if it's not, you're in the camp of maybe, it doesn't really matter. I want to say it doesn't matter if it's 50 or 75. What's much more important is going to be, where do we finish things off? Correct. Then, of course, as we said at the top of the show, how long they keep things at that elevated rate for.
100%.
That said, because we do like to speculate, we do like the horse race, right? And when I covered the world of politics, we always loved campaign horse race because it kind of endlessly gave us in the media something breathlessly to talk about. And not dissimilar here. So what is your bet? Is it 50 or 75 for the odds makers who are watching?
So, if we look at the data we got last week, November employment report, hotter than expected. Wages were even hotter than expected, right? And then we got the ISM services report for November. Again, hotter than expected, and the inflation component was stubbornly sticky. Okay, didn't really retreat very well. So my sense is that the Fed has room to go 75. When will we know for sure? Well, we have the unit labor cost for the third quarter coming out tomorrow. We got the November PPI report on Friday, and we get the CPI report early next week. Depending on what that data says, that's going to cement 50 or 75.
Absolutely. What should people know about some of those data points? Let's take them one by one. What's the first one that you'll be following in the days between now and when Chair Powell and his colleagues get together once again?
The first one's the unit labor costs. Well, we know, as we just talked about with the wages coming out of the employment report, that wage inflation is a big deal. So we want to size this up and see, is that a number that is, forcing employers to pay more wages, right? Are their costs continuing to bubble up? My sense is it's going to be a hot number, and I say that because we can look at some of the other data we got earlier this week. We can also look at the NFIB monthly small business report. They are having a tough time still finding people, and I think last I saw something like 35% of businesses surveyed said they're going to have to raise wages even further. So I expect that's going to be a hot number.
You know, it's interesting. I was listening to the Walmart CEO this morning he was doing some TV interviews, and he had mentioned something similar. He said, some of the higher wage jobs, the ones that might have more attractive benefits, you don't really have a difficulty filling those. At some of the lower wage jobs, or maybe people do. I mean, do you view this as a labor market where people can kind of afford to be a little bit more selective if they're looking to re-enter the market, right? Didn't we just learn we've got 10.3 million jobs right now?
Yes.
We don't nearly have
Yes.
10.3 million Americans.
No.
It's almost two empty jobs, two job vacancies for every one person looking to enter or re-enter the market right now.
Yeah, so it's to use the language, right? It's a job seekers market because people need to hire people, right? But they can, make some onerous demands. But I've also heard businesses, like I was getting my tires changed and my oil changed, and they were complaining that they didn't have enough inspectors because the people that they want to hire have ridiculous demands, right? Not like, 15 or 20 bucks an hour, sky high. So the question is, how do they make money employing people with such robust wages and other benefits? So it's a very tough dynamic.
Yeah, of course. Is there anything you think of top of mind as you see the business headlines? Obviously, you cover the stuff more closely than anyone else. Is there anything you think is fundamentally misunderstood for investors? Are they jumping the gun on things? Are they not taking things into careful consideration? I wonder what stood out to you to say, well, maybe in terms of patience or the long-term fundamentals, people should not forget this. What do those things look like?
Well, I think the one thing right now that I don't think a lot of people are focusing in on is some of the data that we're getting, right? So even though the ISM services number was pretty good, it was still down month over month. If we look outside the US, we got the S&P Global Services PMI for China, the Eurozone, and the UK, all contracted, right? Last week, we got the ISM manufacturing report for those four countries, including the US, contracting. And there's a very big correlation to that data and S&P 500 company revenue. So as that falls, we should be expecting 2023 earnings expectations for that basket, right, which is the market barometer, to come down. And I don't think people are really focusing in on that. When we look at the consensus numbers, they've barely budged over the last week. They need to come down. So that's what I think people need to start looking forward to, is those numbers coming down. As that happens, it means that, the market multiple is going to become more expensive, right? As the earnings come down, the PE actually goes up. The scary part, though, is if we go back in time, the last time the Fed funds rate was around 5%, we were looking at market multiples, 15, 16 times. That tells us that there's potentially downside ahead in the market as we move into 2023.
Especially since we have, I think, a fair share of first-time, younger investors, people that maybe been in the game for a few days. Let's talk a little bit about that history. Is that the Paul Volcker era? Or what are you referencing specifically when we're talking? That was very high.
What are we talking for this is 2005, 2006. So if you look at that time frame, you look at where the market was, we try to use history as a guide. It's not perfect, right? The earnings growth were a little more robust than what we're likely to see next year. But again, it's a guide. Where was the Fed funds last at that level? What were the market multiples? And then we have to adjust, because this is a little hard to say, but investing is it's not a straight science. There's a little bit of art to it. So you have to understand the data. How do you put it all together? How does it round out your mosaic, your tapestry, use your fancy word? But how do you put all those pieces together?
I like both mosaic and tapestry. I'm going to try and work them both in before the show is over once again. I sticking with the broader Fed's conversation, of course, today is election day in Georgia. Finally, at long last, we will have what hopefully the next Congress will look like solidified. The midterm election will finally be done. But I bring that up because I'm often reminded of Jay Powell's kind of unique background for the role. He's a Washington, D.C. guy through and through. He's a Gonzaga Prep product. And many people have speculated in D.C. that maybe he's perceptive to some of the more political, I don't want to say political pressures, given Fed independence, but that he might be more in tune to the conversation around the Beltway than he is with a traditional background. What do you make of maybe his more unique journey that has brought him to the role, and does that set apart his decision making in any way, you think?
So I think that, generally speaking, the Fed chairs are pretty much, ear to the ground, kind of hearing not just the hard data, the soft data, but what the flow is in and around DC. We know that they have to testify several times a year. Obviously, there's a relationship there. What I find more interesting, though, about Powell, which I don't think a lot of people know this, he's actually a student of the Fed and Fed history. So he has keenly studied that time that you just mentioned with Paul Volcker. He's studied other monetary policy under El Maestro, Greenspan, and others. So he's very keen on what the Fed has done, how the Fed has signaled. And when I see him coming out like he did post-Jackson Hole with very firm language, right? I believe he even said, I'm going to speak more clearly than I usually do. That tells you you need to listen. And I hope that people actually take the Fed at their word this time. There's still some thoughts out there that the Fed could cut in the back end of 2023, and I think that's very premature.
Of course, I'm sure if you're Jay Powell, would you like to avoid having your name synonymous with the word shock? The way that Mr. Volcker did, of course. Whenever Paul Volcker's name gets invoked in these conversations, we have the famous Volcker shock.
Correct.
Can't imagine Jay Powell necessarily wants to be in that conversation, as he still sounds. I mean, does he sound optimistic about a soft landing? I feel like it kind of goes back and forth a bit.
So let me ask you a question.
Sure.
What happens if the Fed comes out, the Fed chairman comes out, and he goes, "Oh, things look bad." Right? all heck is going to break loose, right? So to some extent, the Fed, they have to be, they walk a very delicate line. They need to be cheerleaders for the economy, right? This is why, you know, Powell brings his comments out. He goes, you know, the economy is fine, the economy is strong. Almost to reassure and say that, you know, we know what we need to do to fight inflation. The economy can handle it. But again, if they come out and they, throw a bucket of cold water on the market or the economy, it's not going to be good. So you always have to be careful with what the Fed is saying.
Of course. And to this point about a soft landing, obviously the R word is going to continue to be top and front and center.
Jamie Dimon.
And that brings me right to my next question. That was the perfect. That last answer was a tapestry, if you will, to lead us to where we are. JP Morgan CEO Jamie Dimon said persistent inflation could tip the U.S. economy into a recession next year. He's certainly not the only influential CEO to say that. Essentially, if we're not there already, we will be at some point. Your reaction there to those comments from Mr. Dimon?
It's probably going to happen at some point. The question to me is not whether we're going to have a recession, right? The bigger question is how deep and how long. Those are the bigger questions. If the Fed is able to fight inflation, and get us to the right point and maybe stop hiking rates, and then maybe at some point, maybe it's 2024, they can start to ease back a little bit. That could help the economy. But all indications right now are, the data's mixed. So it's very tough, which is why I think people kind of volley back and forth, right? Not only with what the Fed's going to do, again, how much near term, but also what are the prospects of a recession? But, again, to me, the real question is how long, how deep?
Right. But to the point about how long, that really seems like you sound confident they'll be at or near that terminal rate throughout the better part of next year. Is that the expectation?
That's what we at Action Alerts Plus are thinking, yes.
All right. I do want to ask you about the greenback too. The U.S. dollar has erased more than half of this year's gains. We've had this wild sort of series of storylines of the strength of the greenback, and then the conversation began to shift. Why have we seen such a downturn, and when do you expect to see those levels begin to somewhat return to normal?
Well, let's deal with the strength of the dollar thus far, right? Year to date, big headwind for the U.S., right? If you're a U.S. company, say like a Microsoft, very big multinational company, that's a big headwind, and it's not good at a time when we know that some of their end markets are weak or weakening. So as the dollar comes back, all of a sudden U.S. exports become more affordable. That's actually a modest positive. The bigger issue, though, is, again, get back to some of that data that we saw over in Europe or other places, other markets outside the U.S., the demand is not there. So we're seeing export orders really fall. So I'm not really sure what the next move is going to be for the dollar on a sustained basis. The big thing I'm watching is at what point does it dip year over year? That's the big thing to watch.
Of course, American tourists who have gone abroad have probably enjoyed just the anecdotal benefits.
They're flush, yes.
They're flush, right?
They're
and being
flush.
able to go and say, I did this trip last year, my dollar win, I could afford that extra glass of wine with the same amount of money I spent.
Assuming you can afford the airfare, yes.
There we go. Now we're talking a different, wow, what a weird economy we've got, right? In terms of demand all over the place. December, historically, one of the best months for the market. We always talk about the so-called Santa Claus rally that may or may not happen. What is your sense of how these next few weeks could shake out? Of course, keeping in mind we will get some pretty big news next week, of course.
Yes, we will. I think once we have that in hand, we'll have a better sense of where the market's going. If I had to hedge my bets, I'm a little concerned about some of the conferences that we have going on this week, investor conferences where companies are speaking. Really trying to keep our ear to the ground on this for listening about comments of either weakening demand even further than was expected, other headwinds, listening to potential EPS cuts either for the current quarter or for 2023. A week or so ago, Micron came out and they were talking about the continued fall in memory prices, saying it was even worse than when they talked about in September when they had their last earnings call. So it's those types of comments that we're on watch for. As we get that, again, we're likely to see those earnings expectations come in. And I think the market's going to have another, I won't say a bout of indigestion, but another sobering period where it has to adjust to those expectations.
I like the period of indigestion description, though. I mean, it stays in your brain,
It
but
does.
it's not a bad one, though, to help describe the process.
So we think that at a minimum, the market's going to remain volatile, okay? You have to remember, too, that the vast majority of companies will not really talk about 2023 until we're in 2023. So that would be January into February. That's really when we're going to see those 2023 earnings expectations get reset, potentially reset, I'm not sure this is a word, bigly and most likely lower.
I think it's now officially a word, whether or not we wanted it to be.
There it is.
It's now firmly.
Contact Merriam-Webster.
Absolutely. It's huge. It's huge. It's a word. There's a lot of words from that era that are now part of our vocabulary.
Yes.
I know you and I are going to do a special thing for the AAP, the Action Alerts Plus later. I was hoping, though, are you able to kind of preview who are some of those companies? You said one of the things you're looking for is an EPS cut. I wonder if there are certain companies that you will be really focused on as you hear some information, either in the next few weeks or especially at something like the Investors Conference.
Well, we've got Costco reporting on Thursday. We love Costco. It's a very differentiated retail business model. Membership really driving a lot of the profits there. They're continuing to grow their warehouse footprint. So, of course, we'll be, dialing into that. But in terms of other companies that are coming up, we've got Broadcom Avago that's going to report. Given what we're hearing out of China, right, with the curbs that have happened and Apple's manufacturing partner Foxconn really pre-announcing some very challenging November revenue that fell year over year and fell month over month. We're going to want to hear what Avago has to say about that and what does that mean for iPhone shipments, but also the overall smartphone market. What can they tell us about other connected device and excess inventories that are in the market?
That was an excellent answer for a number of reasons. Number one, it becomes a plug to people who watch this show who might not yet be members of the portfolio to consider to join along. So you get that information that you need to know, when to buy, when to hold, what to avoid. He also led us to our next topic, which is China.
Okay.
What do you make of these reports that we've seen? I mean, is this, a lot of people who maybe follow it loosely will say, well, I saw all the headlines, I saw these images of protests, and now I see headlines of the country starting to say, maybe we loosen some of these tightly held policies. People may be wondering, is there a link? What do you make of the timing, and what more do we know?
I think that they need to, right? Clearly the economy has been suffering. There's a lot of outrage over there in these protests. It's interesting to me that might have actually subtly influenced the decision. So that's actually a big deal when you think about it. But I also think, though, that they're using Omicron and its more flu-like symptoms as an excuse to do something that they should have done sooner. So, we'll have to see what the data brings.
And by, if you don't mind me popping in, by do something sooner, you mean loosen restrictions?
Loosen restrictions,
okay.
Yes. But like I just said, a minute ago, Foxconn gave out some pretty horrible November data. We're not out of the woods yet. We need to really get all the information out for this quarter, and then maybe we could start to see some real progress in early 2023. But remember, it's winter. And last winter, the winter before, not very good in terms of COVID cases. So we still need to be careful, I think.
Yes, but I mean, even here in New York City, parts of Washington, D.C., we all were really hit with that powerful wave, really toward the middle of end December, right? We had that big rush where people were finally getting together for holiday parties.
And then boom.
And then we had a big boom impact. So that's great. I'm glad you bring that up in terms of perspective for people who may have forgotten and think that we are now kind of in a post-pandemic era. We certainly are not.
Well, that's, one of the things we try to do with AAP is we really try to think about what's ahead of us. What are the opportunities? What are the hurdles? What do we need to be, concerned about? Any potential potholes? And you've got to look, on a rolling basis. This is not crockpot investing, right? You don't fix it, forget it, see you later. this is, we're not traders either, though. We're not buying and selling stuff every day, but we're active investors, meaning we're constantly thinking about the portfolio, constantly thinking about the economy, companies we might want to bring into the portfolio, companies we might have to, take some profits on, which is always a good thing.
Absolutely. Since you mentioned Apple and Foxconn earlier,
Yeah.
what more could you tell us about at least some of what we know? How is Apple trying to start to unwind its over-reliance on China? We have started to see them start to put some pieces in play to minimize that country's impact. Is that a fair read?
I think it is. I think it will take time, unfortunately. I mean, the nice thing is that Foxconn has facilities not just in China, but they have some in India as well. I think that's going to be one of their big hubs that will actually help Apple's prospects in India as well. So I think we're going to see more of that there. But the other thing, too, though, not to discount, is what we're going to see really in 2023 with the CHIPS Act. And we're going to start seeing the reshoring of semiconductor capacity here in the States. I think that's a great thing for companies like Applied Materials, ASML, Lam Research. But as an investor, we have to wait for that flow of funds to begin. And that's probably not going to happen until the middle of the year. But getting back to Apple, Taiwan Semiconductor, I think, said today that they are going to spend not originally $12 billion like they thought in Arizona, $40 billion. So clearly there's a lot of pressure to bring that capacity here. And I think Apple, who's happens to be their largest customer, that might help them also diversify their manufacturing footprint.
That's amazing. Taiwan Semiconductor, one of the most important names that maybe a lot of domestic investors have not necessarily heard of. If you don't specifically engage with that space, or if you haven't recently looked at the companies globally in terms of market cap, you might be stunned to look at this list and say, who is this name I'm unfamiliar with? But man, are they a huge player.
They are the who's who when it comes to manufacturing chips for third parties. So there's Apple, there's Qualcomm, AMD does a little bit, NVIDIA does a little bit. So they are like the hub. And that's why from a geopolitical perspective, we, the US, where we consume a tremendous amount of chips, our companies that are headquartered here use a tremendous amount of chips. That's why there's a very close watch on Taiwan and China.
Absolutely. We also consume a large number of potato chips, but that's for when Lay's and the folks in that food and beverage do their
I figured
earnings.
you were more of a Dorito guy. I sense a Pepsi question coming.
I mean, I can. Do you have a favorite chip? This is actually something we sometimes do with Martin on the morning show, believe it or not. I'm a very serious journalist. I ask the hard questions, as you know.
So you will know this. You will know this, Chip, because you were down in D.C.
Yes.
So a lot of folks are like, oh, Ruffles or Pringles or this or that. I actually like Utz potato chips, but there's a certain one, and this is what you will know.
Okay.
The crab chip.
Oh, yeah. Is Utz a Maryland company? Oh, it's not. It's got this whole Maryland vibe to
I
it
don't
with the
know
crab
if
chip.
it is or not.
I love it down there.
But the company who owns the spice that they use, Old Bay, is one of my favorites. I can't say what I usually say this time of year because people groan when I say it now, but that company is McCormick. MKC, which is a wonderful company.
There you go.
And it's in terms of disclosure, it's a resident in the AAP portfolio.
Okay, fair enough, but it's still a great answer, though, regardless, and I appreciate that, and thank you again for letting me ask the difficult questions.
Sure thing.
That's why you're here on the floor of the New York Stock Exchange, to answer your favorite type of chip, and it was a great answer. Time now for our rapid fire section. You want to talk PepsiCo?
Let's do it.
There we go. You just teed it up. That company laying off hundreds of workers at its North American headquarters. Is it a sign that layoffs are spreading a little bit beyond the massive tech headlines that we've seen the last month or so?
So again, context, perspective is everything. Hundreds of people. They employ 300,000 people globally, 129,000 in the U.S. alone. Right sizing at best.
Okay, fair enough. Head on here to number 2. Let's talk Intel. That company says it's on track to regain chip production leadership. What do we know?
The big issue is what the CFO said yesterday, I believe, speaking at a conference. Still struggling with inventories. The outlook is not, quote, pristine. That's the latest warning that we've heard. We talked about Micron a little while ago. This is, again, why we really want to hear from Broadcom, Avago, when they report later in the week to get the latest and greatest on what's going on.
Latest and greatest. And since we were just talking about chips, let's double dip on a topic we already hit, but I want to get your take on it. I haven't even had my caffeine yet today.
Yes,
but
I know.
Let's go back to Taiwan Semiconductor to round out the broadcast. Set to triple its investment in the U.S. How significant is this?
That is a big deal.
Yeah,
that is a big deal. And like we talked about, it's all part of the reshoring of U.S. chip capacity. This is a big deal. And again, I think later in mid-2023, when the funds are flowing, that is the time to take a look at, some of the biggest semiconductor capital equipment companies, because you can't have a fab, right? You need the machines to make the chips that go in the fab, and those are the companies that make those machines. So those are the companies you want to buy first.
And I think you said the state was Arizona specifically,
That
right?
is correct, yes.
Absolutely. I know that'll be welcome news by many. The great Chris Versace joining us here on the floor of the NYSE. This was great, man. Thanks again.
Happy to do it. Thank you.
We'll do it again soon. That's going to do it for the Market Open here from the floor of the New York Stock Exchange, my friends. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.